Hi everyone, making a quick video today over fixed indexed annuities. Why I'm making this video is I've had a lot of clients that are very concerned about market volatility, especially in these times that we have been living in. So I wanted to give a brief explanation as to what these types of products are and how they could potentially fit into your retirement picture. Full disclosure, I am a certified financial planner. I have my own practice and do my own business with my own clients. If this information pertains to you, please feel free to contact your local advisor or trusted attorney or CPA or whomever is helping you with your finances, or feel free to call our office to see if this is a suitable investment or option for you. But before we begin, I am not an artist by trait, but I do draw pictures from time to time. So I have, again, this is a flyer I was thinking about putting together for individuals, but wanted to more or less give some basic information on, again, these fixed indexed annuities. What are they and how do they work? For the most part, they are a hybrid between markets, stock markets, and bonds. That's kind of how I like to describe them. Again, I say a hybrid or an analogy because it is not exactly that. But in short, how it works is when the market goes up, these products do tend to perform upward depending on the underlying index that you choose inside of that profile or inside of that investment. If the markets go down, they tend to, depending on the underlying index, give a 0% return, or if there are any negative returns, it is normally based off of internal fees. So picture I'm going to allude to over here is this whiteboard that I've drawn. So how these annuities work, I'm going to work from right to left in this scenario. Let's talk about performance. When the market goes up on one of these types of products, you might get 70% of the upside. When the market goes down, you're not going to get any of the downside. Other things that are applicable for at least most of the products that I talk about, others within the industry as well, there tends to be a bonus that is offered off of the income generating piece inside of these annuities, which I'll get into here in just a minute. This one's going to be 25%. When we're talking about taking income annuities, I do like to illustrate or articulate a lot of the time as yin and yang with life insurance. So life insurance pays out when you die. When do annuities pay out? For as long as you are alive, if you are trying to take advantage of some benefit or lifetime income benefit offered inside of those annuities. There does tend to be an enhanced death benefit option if you die too soon. And there are some long-term care perks, which we will dive into depending on the type of product, if you were to ever land an appointment at the office or whatever it may be. But back to this picture or my drawings. In this example, we've got an annuity. Somebody puts in $100,000. Let's assume this person is 61 for sake of wanting to retire at 65 after 4 years. Let's assume this person invested $100,000 into this annuity. They are going to get a 25% bonus, as I'd indicated over here. That bonus is going to represent $125,000 as a starting point. This is today's date, or today is July 10th. Out in the future, let's say somebody did a policy like this. This is going to represent the index from today. And we're just going to look at this over a 1-year period. There are multiple different types of indexes that are going to perform differently, but this is a participation index. So how this index works is when the market goes up again, you get 70% of that upside. So if the index, when I say market, when the index goes up by 10%, you get a 7% increase on your investments. This is assuming that you are in the growth phase of your investments, meaning you're not taking any income from the investments. I'll jump to that here in years 3 and 4. Now let's talk about and that's year number 1. So what I am also doing here is I'm going to be moving my end of year down to 8/1 of 2024 down here. So if you consider the performance that happened inside of that annuity, that starting value is going to be $133,750 at the beginning of the year with a 7% return last year. Let's say the market goes and goes. There is a 20% dip in the market. You are going to get a 0% return in this hypothetical scenario. So we're going to again move this dot down to here as the 8/1 of 2025. You had a 0% return that year, so your money's going to stay the same. Let's say you decided you wanted to take income in this scenario. So forgive me, I said 61-year-old. I should have said 63-year-old in this case, because in the 3rd year when he turns 65, he is wanting to take income from this policy. Well, he is going to be able to draw 4% off of whatever we turn this number into as an annual payment or a lifetime income. I cannot call it a pension per se, but it's going to look and act and feel like one or like Social Security. So how this works, this person can take either this as a lump sum check, they can divide it into quarterly checks, monthly checks, whatever is most convenient depending on the insurance carrier, but they're going to get $5,350 the first year on their income. Let's just act like they take it all day one. Well, what happens with the market throughout that year? It goes and goes and goes and goes and goes. Let's say the market went up. In this case, it went up 15%. Well, if you remember the rules, you're going to get 70% of that upside. Not only is that going to be credited to the performance of this policy like it does in years 1 and 2, it is also going to increase or give you a pay raise on your guaranteed lifetime income. So you're going to get a 10.5% pay raise. That means next year you're going to get $5,911 as your annual income payment. It will stay there for life. They act as a watermark, meaning that for as long as this person lives, they're going to get paid at least $5,911 per year from the insurance carrier until they die. If they have not pulled back out their $100,000 that they put into this policy, there would be a death benefit that would be credited to the beneficiaries. The enhanced death benefit would be this extra bonus. They could take it out over a certain period of time. I believe it's going to be 5 to 10 years in most cases, but this is just an example of how one of these fixed indexed annuities could work. Why individuals like them is they tend to take volatility out of the market quite a bit, as a matter of fact, because you are not going to be having any negative return years, at least if you're picking the certain types of indices inside of those annuities. So that is a whole other can of worms to open up another day. Just wanted to make a brief video on maybe helping individuals understand what a fixed indexed annuity is and why it may be useful in a retirement portfolio. About safety, last little piece on this. I do a lot of business with some A- rated carriers out there. That means that they're going to have an excellent or a very stable rating and the ability to pay their ongoing obligations or those incomes that they have for their clientele or their death benefits if they sell life insurance, amongst some other things. So I just, again, wanted to give some brief information on what a fixed indexed annuity is. I hope this is useful. If it is, please feel free to share this video with anybody who may benefit from a conversation with me or at least knowing this information. Again, I am a certified financial planner offering investment management, financial planning, health insurance, life insurance, annuities, long-term care, homeowners insurance, auto insurance, the whole 9 yards. Officially a one-stop shop. Just wanting to share some value with you. So please like, subscribe, share, and tell anybody and everybody about me if you can. So have a great day. Thank you.